If you are 60 or older and you paid federal income tax this year, there is a very good chance you paid more than you owed. Not because you cheated, not because you made a mistake, because the IRS quietly created 3 tax breaks specifically for seniors, and most retirees never claim them. These are not loopholes. These are not tricks. They are legal deductions and credits written directly into the federal tax code. The IRS does not call you and remind you they exist. In 2026 alone, one of these breaks is worth up to $6,000 per person, and it is brand new. If you were born before 1966 and filed your taxes this year without knowing about these 3 breaks, you may be owed a refund right now. This video will show you exactly what they are, who qualifies, and the exact IRS form number to use for each one.
The IRS isn't going to send you a letter about money you missed. The tax code contains dozens of special provisions just for seniors, but the system is built on a simple, costly assumption that you will find these benefits yourself. If you don't claim them, the IRS simply keeps your money. For example, many seniors are eligible for a higher standard deduction just for being over 65, and a new temporary enhanced senior deduction could be worth an additional $6,000. Even common medical expenses like Medicare premiums or prescription drugs can often be deducted, but again, you have to be the one to claim them. These are not loopholes. They are established rules designed to help you. Free resources like the AARP Foundation Tax Aid or the IRS's own tax counseling for the elderly can help you navigate the system. Don't let what you've earned slip away.
According to the IRS's own tax counseling for the elderly program, millions of seniors over the age of 60 file their taxes without claiming all the benefits they legally qualify for. The 3 breaks in this video are not obscure. They are not rare. They are standard provisions that have applied to seniors for years, with one major new addition added for 2026. But most seniors are either unaware they exist or they assume they do not qualify because of their income level. In many cases, they are wrong. The income thresholds are lower than most people think, and that means more seniors qualify than they realize.
Why does this happen? 3 reasons. First, the tax code is written in legal language that most Americans cannot read easily. A senior on a fixed income is not searching through IRS publications for line item deductions. They fill out their return, they pay what they owe, and they move on. Second, tax software does not always flag every break. Some deductions require a separate schedule. If you do not know to attach it, the software will not always prompt you. Third, the rules changed in 2025. Congress passed the One Big Beautiful Bill. That law created a brand new, temporary senior deduction worth up to $6,000 per person, starting with your 2025 tax return, which you filed in early 2026. Most seniors did not hear about this change. Most tax articles did not explain it clearly. That means millions of Americans filed their 2025 return this spring without claiming the new deduction. If that is you, you may still be able to fix it. Here are the 3 tax breaks. Exemption 1, the new $6,000 senior bonus deduction. This is the one most people missed in 2026. Starting with the 2025 tax year, Congress created an enhanced deduction specifically for seniors age 65 and older. The amount, $6,000 per qualifying person. If you are married and both spouses are 65 or older, that is $12,000 combined. This deduction stacks on top of your regular standard deduction and on top of the existing age-based deduction seniors already receive. Here is what that means in real numbers for a single senior in 2026. Regular standard deduction, $16,100. Extra age-based deduction for seniors, $2,050. New $6,000 bonus deduction, $6,000. Total deductions available, $24,150.
According to the IRS, the average Social Security benefit for a retired worker is about $24,000 per year. For many single seniors, this means their entire Social Security income could be sheltered from federal tax entirely. Now, there is an income phase-out. The $6,000 deduction begins to reduce if your modified adjusted gross income exceeds $75,000 as a single filer, or $150,000 for married couples filing jointly. If your income is below those thresholds, you likely qualify for the full amount. To claim it, you must file Schedule 1A with your Form 1040 or Form 1040-SR. The deduction is available through the 2028 tax year. If you filed your 2025 return without claiming this, you can file an amended return using Form 1040-X. You have 3 years from the original filing deadline to make this correction. Exemption 2, the medical expense deduction. This is the most consistently overlooked deduction for seniors because most people think they do not qualify. Here is the rule. If your unreimbursed medical expenses exceed 7.5% of your adjusted gross income, everything above that threshold is deductible. That threshold is now permanent, locked in at 7.5% under the Consolidated Appropriations Act of 2021. Congress permanently rejected the higher 10% floor that once applied. What counts as a medical expense? Medicare Part B premiums, Medicare Part D premiums, dental care, vision care, hearing aids, prescription drugs, long-term care insurance premiums up to IRS age-based annual limits, transportation to medical appointments, even certain home modifications for medical necessity.
Here is how the math works. Say your adjusted gross income is $40,000. 7.5% of $40,000 is $3,000. That is your floor. Now say you paid $2,400 in Medicare Part B premiums, $600 in Part D premiums, $800 in dental care, and $1,500 for hearing aids. That is $5,300 total. Subtract your $3,000 floor and $2,300 is deductible. The key, you must itemize on Schedule A to claim this deduction. Use Form 1040 or Form 1040-SR. Many seniors assume itemizing does not make sense after the standard deduction increased. But if you had a high medical year, a surgery, a major dental procedure, expensive hearing aids, long-term care costs, your medical expenses alone may push you over the line. Check your receipts, check your Medicare statements, check what you paid out of pocket in 2025.
Exemption 3, the credit for the elderly or disabled. This is the most underused tax credit available to seniors, and most people have never heard of it. A tax credit is more powerful than a deduction. A deduction reduces your taxable income. A credit reduces your actual tax bill, dollar for dollar. This credit is called the credit for the elderly or the disabled, and it is claimed on Schedule R, attached to Form 1040 or Form 1040-SR. Who qualifies? You must be age 65 or older, or you must be under 65, retired on permanent and total disability, and receiving taxable disability income. The credit before income reductions ranges from $3,750 to $7,500, depending on your filing status. Now, the income limits are strict. If you file single and your adjusted gross income is $17,500 or more, you do not qualify. If you are married filing jointly and only one spouse qualifies, the AGI limit is $20,000. If both spouses qualify, the AGI limit is $25,000.
This credit is designed for lower-income seniors, but here is who misses it. Seniors with Social Security as their only income, widows and widowers living on survivor benefits alone, and retirees with small pensions whose total income stays under the threshold. If your income is low and you have not claimed this credit, you may have been leaving real money on the table for years. The actual credit calculation is done using the worksheet inside the Schedule R instructions. You do not file the worksheet, but you must keep it in your records. The credit is non-refundable, which means it reduces your tax bill to zero, but it does not generate a cash refund beyond what you already overpaid through withholding. The IRS maintains the full rules for Schedule R at irs.gov/credits-deductions/individuals/credit for the elderly or the disabled. Here is exactly what to do. Step 1. Confirm your age qualifies. If you were born on or before January 1st, 1961, you were age 65 by the end of the 2025 tax year. You qualify for the age-based senior deductions. Step 2. Pull your 2025 return and check 3 things. 1. Did your return include Schedule 1A? If not, you may have missed the $6,000 bonus senior deduction. 2. Did your return include Schedule A with medical expenses? If you paid significant out-of-pocket healthcare costs in 2025, calculate whether they exceeded 7.5% of your AGI. Find your AGI on line 11 of your Form 1040. 3. Is your total income below $17,500 if single, or $25,000 if married filing jointly? If yes, pull out Schedule R and see if the credit for the elderly or disabled applies. Step 3. Get free help if you need it. The IRS runs a free program called Tax Counseling for the Elderly, called TCE. Volunteers trained specifically on senior tax issues will prepare your return at no cost. To find a TCE location near you, call 1-800-829-1040. That is the main IRS helpline. Or visit irs.gov/individuals/free tax return preparation for qualifying taxpayers for the full list of free filing sites. Step 4. If you missed deductions on your 2025 return, file an amended return. Use Form 1040-X. You have until 3 years from the original filing deadline, typically April 15th of the year you filed, to correct a return and claim a refund you missed. You can download Form 1040-X at irs.gov/formspubs/aboutform1040-X.
Step 5. Keep all documentation. For the $6,000 senior deduction, keep your proof of age and Social Security number. For medical expenses, keep every receipt, Medicare statement, and pharmacy invoice from 2025. For Schedule R, keep the completed worksheet and any physician statements if claiming disability status. The IRS does not require you to submit most of these documents with your return, but you must have them if you are audited. Here is the full picture. The IRS will not call you to tell you about these 3 tax breaks. You have to know they exist, know if you qualify, and claim them yourself. Exemption 1, the $6,000 new senior bonus deduction, available to every taxpayer age 65 or older with income below $75,000 single or $150,000 married filing jointly. File Schedule 1A with your Form 1040 or 1040-SR. Available for tax years 2025 through 2028.
Exemption 2, the medical expense deduction. Any unreimbursed medical cost above 7.5% of your AGI is deductible. Medicare premiums, dental, vision, hearing aids, and long-term care all count. File Schedule A with your Form 1040 or 1040-SR. Check line 11 of your 1040 for your AGI. Exemption 3, the credit for the elderly or disabled. A direct reduction of your tax bill, not just a deduction. Credit ranges from $3,750 to $7,500 before income reductions. Income limit, $17,500 AGI for single filers, $25,000 for joint filers, with both spouses qualifying. File Schedule R with your Form 1040 or 1040-SR. If you were born before 1966 and you did not claim these 3 breaks on your 2025 return, you have time to fix it with Form 1040-X. Call the IRS free helpline at 1-800-829-1040 or find a free TCE tax site near you at irs.gov. Subscribe to Nami Finance USA so the next tax change that affects your retirement income never catches you off guard.